So, can real estate depreciation offset your stock capital gains? You've probably heard that real estate depreciation is a tax shelter, but can it actually offset stock capital gains? The answer might surprise you. Have you ever wondered, do the paper losses in real estate offset stock capital gains? So in this video, I'll explain what's allowed, what's not, and how to make it work legally. By the end of this video, you'll know, do real estate losses with depreciation offset your capital gains from stock sales? How the IRS separates these different types of income, and strategies that are going to maximize your tax efficiency. I get this question asked to me all the time, and I want to break down what is real estate depreciation. Depreciation is a non-cash expense that reduces your taxable income on paper. It's the IRS's way of acknowledging that buildings wear down over time, even if the value of the real estate goes up. Traditional depreciation schedules are 27.5 years for residential property and 39 years for commercial real estate property. So how is depreciation calculated on a straight line basis? Well, you're going to take the value of the land, exclude it from the value of the property that you bought. So say you bought a $3 million property and $300,000 of that is allocated to the land. The other $2.7 million would then be divided up over the 27.5 years if it's an apartment building, or 39 years as a commercial building. And each year, that would be the allowance for the non-cash real estate expense that will run through the profit and loss, and the losses will flow through to you as the investor. Passive income versus active income, the IRS distinction. Real estate rental income and losses are classified as passive income per the IRS regulations. Stock gains are classified as portfolio income, so they're not active or passive. You cannot directly use passive losses like depreciation to offset portfolio income like stock gains unless you meet certain expectations. So here's a scenario when real estate losses cannot offset stock capital gains. You own rental properties, you receive rental income, and you're not a real estate professional. In this scenario, passive losses cannot offset stock capital gains. You have a full-time job and you invest in real estate passively. In this case, the losses generated from real estate will only offset other passive losses or other rental losses, rental income losses that come in from real estate investments. So to be clear, depreciation losses are locked in as passive losses from real estate investing. You cannot use these to offset W-2 earned active income or ordinary income, or to offset your stock capital gains. Now, there's two scenarios when depreciation can help. First scenario is you qualify for real estate professional status. This is an IRS designation that you are a real estate professional. Check out in the description below, there is the video that I have regarding how to qualify for real estate professional status. That way you understand how you become a real estate professional without being a realtor or getting a real estate license. If you do qualify for a real estate professional status, then you can use your passive losses to offset active and portfolio income. This is the greatest tax law that there is in America, in my opinion. By being able to be a real estate professional, all the losses that you generate now can offset all of the income that you receive through ordinary income from your job, from passive income from real estate investments or sales, and portfolio income like stock dividends and capital gains from stock sales. Depreciation helps when you are receiving a large capital gain from real estate. So if you choose to sell a piece of real estate and you have a large gain, using the losses, they carry forward, or if you have additional passive losses from real estate, it will offset your large capital gain and help reduce tax liability. Now remember, you must receive the losses in the same calendar year as you made the sale occur. So if you buy real estate in the following year after you've made the sale on the real estate, you cannot use those future losses to go back in time in the previous year and offset that capital gain. Now, if you generate losses in the past from real estate and you did not use them, they do carry forward. So if you have accelerated losses that carry forward and you have a large capital gain in the calendar year that you sell, those losses can be used to offset those capital gains taxes. That's where strategic planning options come into play. Timing is everything. Timing when you sell your stocks and when you sell your real estate is critical to strategizing to defer or offset tax. If you are a real estate professional and you buy property in a calendar year where it generates a lot of depreciation losses, and you are going to not use those losses because there's not a lot of rental income, then selling stock in that calendar year would be beneficial. That way you can utilize the losses from real estate and offset the capital gains from the stock sale. Now remember, this is only if you're a real estate professional. Caveat to that, you and your spouse, one or the other, can file jointly, and then you can qualify for real estate professional status. If you do file jointly, then you get to both benefit from the passive losses of real estate and the active or portfolio income generated from stocks or your business income. They have to have a spouse, one of you, that do qualify for a real estate professional status for this strategy to work. Another key strategy is when you're generating a lot of passive losses from different real estate investments, electing the grouping activity where you have a holding company or you group all your real estate investments together on your tax return. That does allow all those activities and all those losses to flow through. That way, if you have positive cash flow on one asset and negative losses on the other, they can offset all of your real estate passive income. So none of your real estate income will be taxed in that calendar year if you had enough losses to offset the rental income. Utilizing capital loss harvesting. This is a strategy stock guys love to use. I'm not very familiar with it, but tax loss harvesting is very popular now in the marketplace where generating losses through stocks, they are able to offset gains in stocks. So if you have a large loss and you're cutting loose of the stock, or if you have a strategy that generates tax loss harvesting from stock investing, then timing when you sell your stock with the year that you generated losses is critical so you can offset that stock capital gain. So what can you do to help offset more of your gains? Well, first off, achieve real estate professional status. That is an amazing strategy to help offset all of these taxable gains. Next is accelerate depreciation. And that means getting a cost segregation study on the properties that you buy and then utilizing bonus depreciation where you can now receive a large loss in that calendar year up front, accelerated at the beginning of the ownership period of the asset, and then use those losses to offset other forms of rental income. Also, you can reinvest your profits or sales from stocks in real estate. That way you generate more losses from the real estate that you buy, rather than reinvesting in stocks and receiving no tax benefits. Work with your CPA to time out these key events. If you know you're going to sell a large portion of your stock portfolio, timing is critical. Work with your CPA to proactively time out when you're going to have a large capital event. If you're going to sell a large piece of real estate, make sure that you either can 1031 exchange into another real estate asset, deferring the tax, or you can buy another property and accelerate depreciation to offset that capital gains tax. And if you're thinking of selling stocks and you would like to get liquidity, then timing out when you can become a real estate professional, you or your spouse, or if it's a year where you haven't received a lot of income and you may fall into a lower tax bracket. So working with your CPA is critical and doing it ahead of time, proactively, not waiting until after the sale or after the decision is made that you're going to be selling your business, your real estate properties, or your stocks. So now that you know how depreciation works and you are clear about how to offset stock capital gains with real estate losses, what you can do, what you can't do, I want to dive into the next video about the 1031 tax-deferred exchange for real estate. It is a key strategy to help you defer taxes, and there is a way to not pay tax through the 1031 exchange. I'll show you in the next video.